In the ever-evolving world of manufacturing, one of the most crucial aspects that often gets overlooked is the proper capitalization of manufacturing standard cost variances. If you're in the thick of it, you know that understanding how to handle these variances is not just a matter of compliance. It can significantly impact your financial statements and ultimately your bottom line. So, let's break down the intricacies of this topic in a way that's engaging and relatable, yet informative enough to give you the insights you need. First off, let's clarify what we mean by manufacturing variances. In simple terms, these are the differences between the standard costs that you've set for your manufacturing processes and the actual costs incurred during production. Think of standard costs as your budget or plan. They're what you expect to spend based on historical data and industry benchmarks. When things go awry, whether due to unexpected material costs, labor issues, or inefficiencies in production, those variances can throw a wrench in your financial reporting. Now, the question arises, how do you capitalize these variances according to US GAAP? It's important to note that while standard costing isn't a GAAP-approved method for inventory valuation, many businesses still use it for internal analysis. This leads to a critical step, adjusting those variances on your balance sheet and income statement to align as closely as possible with GAAP principles. One common approach is to set a threshold for capitalization. For instance, you might decide only to capitalize variances that exceed a certain dollar amount. This is a practical way to avoid cluttering your financials with minor variances that don't significantly impact your overall financial picture. But it's not just about setting thresholds. You must also determine which variances to capitalize and which to expense immediately. Consider this: if you have an unfavorable variance due to abnormally low production levels, it might be more appropriate to expense that in the current period rather than capitalize it. The rationale here is straightforward. It reflects the reality of your production capabilities and helps keep your financial statements transparent. On the other hand, variances that are part of the normal course of business, like fluctuations in raw materials prices, are typically capitalized and amortized based on inventory turnover. Speaking of amortization, let's dive into how you determine when to start that process. Some companies opt to amortize a portion of the capitalized variances in the current period to reflect any inventory consumed. Others might choose to wait until the next period. The key takeaway here is consistency. Whichever method you choose, apply it uniformly across your financial reports to maintain clarity and accuracy. Now, let's talk about standard costing and capitalized variances. Although it's not a GAAP-approved method, many businesses find value in using standard costs to analyze performance. However, the variances must be adjusted in a way that aligns with GAAP standards. This means that while you might initially record most inventory variances, how you amortize them is critical to ensure compliance, accuracy, and financial reporting. You might wonder about the different categories of variances you'll encounter. One major category is the purchase price variance. This refers to the difference between the purchase order price and the standard cost. Generally, PPV variances are considered part of the actual cost of inventory and are capitalized. As inventory is sold, these variances are then moved to the profit and loss statement. The common practice is to amortize them based on the number of days your inventory turns over, which can provide a clearer picture of your financial health. But let's not forget about the variances that arise from the production process itself. For example, if you have to rework goods or if your bill of materials includes costs that weren't actually incurred, these variances typically don't increase the value of your inventory. Instead, they're seen as period expenses. This is crucial because it reflects the true costs associated with production and helps maintain the integrity of your financial statements. Then there are the variations in yield or scrap. These arise when there's a departure from your standard cost, especially under actual costing systems. Generally, these are treated similarly to PPV variances. If you have fewer items in stock than your records indicate, you'll experience a financial loss. This discrepancy can be reported as a loss on your tax return, which can help offset your taxable income. Now, let's touch on some of the pitfalls of improper capitalization of manufacturing variances. One significant risk is the temptation to capitalize labor expenses associated with inventory. While it might seem appealing to spread these costs over time, it's essential to expense them in the year they were incurred. The SEC has found that many businesses incorrectly capitalize expenses to inflate annual income figures. This practice can lead to significant long-term repercussions, including audits and potential penalties. When evaluating your inventory valuation methods, it's vital to ensure consistency and accuracy. If your records indicate discrepancies, it's worth investigating whether different valuation methods are at play. For instance, if someone taking inventory mistakenly assigns the wrong value to units, it can lead to significant misreporting. Always ensure that your inventory count is based on a single valuation criterion, the invoice amounts or retail value. Let's illustrate this with a simple example. Imagine you're running a new business and your standard cost for producing 10 units is $100 worth of raw materials. If an accident occurs and you spill those materials, resulting in an efficiency variance of $100, you'll need to navigate how to account for that. If you've sold half of those units by the end of the month, you would recognize $50 of that variance in the current period, capitalizing the remaining $50 alongside the standard cost of the product. This approach maintains the principle of matching revenue with expenses. Manufacturers often worry about capitalizing variances when they produce more units than they sell in a given period. But here's the silver lining: if all produced units are sold within the same period, variances effectively offset the sales revenue. This means you can focus on meeting demand without getting bogged down by the intricacies of variance capitalization. However, tracking capitalized variances can sometimes feel more painful than the value it brings. The complexity of considering multiple factors like material cost, labor, and overhead can be overwhelming, especially for businesses with intricate operations. Variances can fluctuate significantly, making it challenging to gauge your financial health accurately. This is where a robust system for tracking these variances becomes essential. Consider leveraging technology to ease the burden. Implementing software designed to automate variance tracking can free up valuable time and resources. Additionally, having a clear understanding of your accounting policies will help avoid mistakes. Regular reviews and audits of the data entered into your system can further ensure accuracy and compliance. If you find yourself facing significant one-time adjustments due to improper tracking, it's time to reevaluate your systems. Capitalizing a variance essentially means booking it as an asset on your balance sheet, and without a sound tracking system, these variances can quickly add up. Using software tools tailored for variance management can help keep your financial statements in check. Moreover, it's essential to have an expert cost accountant on your team. They can provide invaluable insights and ensure that all relevant data is captured and analyzed correctly. This expertise can be a game changer in mitigating risks associated with capitalized variances, allowing management to make informed decisions based on accurate financial data. In conclusion, navigating the world of manufacturing standard cost variances is no small feat. It requires a careful balance of understanding GAAP principles, accurately tracking variances, and ensuring compliance with financial reporting standards. By setting thresholds, determining the appropriate treatment for different variances, and leveraging technology and expertise, you can optimize your variance capitalization process. Ultimately, this will not only enhance the accuracy of your financial statements, but also provide a clearer picture of your business's true profitability. So, take the time to invest in your systems and processes. Your bottom line will thank you for it.